The modern marketing pitch for the financial markets is built on the promise of effortless entry. Zero-fee trading apps and viral social media trends suggest that building wealth is now as simple as a single tap on a glass screen. When economists analyze the actual trade logs of millions of individual accounts, the results deviate sharply from that promise. Statistics show 80% of day traders quit within 2 years. Of those who remain, only 1% manage to generate a predictable profit after accounting for fees. Despite having the same tools as professional firms, the majority of the capital entering this ecosystem is systematically drained away from individual accounts. Academic research has identified a specific phenomenon called a retail order imbalance, a situation where individuals are buying a stock much more aggressively than they are selling it. In the short term, these retail imbalances actually predict that a stock's price will rise. This means the crowd is successfully identifying stocks that are about to move upward. Yet these same traders collectively lose billions of dollars on those very same assets. This creates a massive contradiction. It is possible for a group of investors to be right about the direction of the market, yet still end up completely broke. Researchers analyze an equal-weighted portfolio, investing the exact same amount into every trade. Following this approach, retail winning picks actually profit. But in reality, traders concentrate capital. They make small, smart trades, then pour their savings into one single, highly volatile stock. The largest losses happen in the exact stocks where retail buying volume is the most aggressive. Portfolios are destroyed because a few massive emotional bets end up wiping out the gains from dozens of smaller, smarter decisions. Viral social media feeds and online forums have largely replaced traditional financial analysis for the modern trader, creating a powerful engine for this capital concentration. Retail volume consistently spikes during attention-grabbing events, a pattern that has held true from old-school newspaper columns to modern televised stock picks. By the time a stock is trending on a social feed, institutional money has often been holding that position for weeks. As the retail crowd rushes in at the peak of the hype, institutional buyers begin to sell. The momentum exhausts itself, and the price reverses. This influx of late-stage retail buyers provides the exit liquidity that professional firms need to close their positions and lock in their profits. Once a trade turns negative, the disposition effect takes over. This is the cognitive bias that causes people to sell their winning stocks too quickly while holding on to their losing stocks for far too long, simply to avoid admitting failure. This data shows that during periods of extreme market stress, retail investors are consistently net buyers. They are doubling down on falling stocks, driven by a hardwired aversion to realizing a loss. Online communities often frame this refusal to sell as a sign of strength, using terms like diamond hands to encourage traders to hold on to plummeting assets. This risk is often multiplied by leverage, the practice of borrowing money from a broker to increase the size of a position. When emotional holdouts use borrowed money to fight a falling market, a single bad trade can liquidate an entire lifetime of savings in seconds. Many retail traders view their initial losses as the cost of trading to learn. Researchers argue that risking capital in a complex market without a proven system is more akin to playing roulette to learn the laws of probability. The modern individual is competing against high-frequency trading algorithms. These systems execute trades in milliseconds, operating without the interference of human ego or hesitation. Trading platforms are designed to exploit recency bias, the tendency to overvalue the latest news, keeping users in a state of constant, impulsive engagement. The market operates as a zero-sum mechanism. It is a system specifically designed to transfer wealth from the distracted and the emotional to the disciplined and the automated. An investment strategy that relies on social media trends and borrowed capital places the individual at the very bottom of the financial food chain.